Hello everybody, welcome back to Financial Trading Basics Part 24, Inflation and Dilution. Economics today, not really trading, because the point of this video is I'm going to just make some basic statement of facts saying we can't, because we don't really know the global wealth, we don't really even have a consistent way to value companies or valuations in general. Because of unknown global wealth and open economy, that our dilution and our inflationary environments are not really predictive of trades. Again, our distinct definitions. In physics class, inflation clearly means extreme rapid expansion very quickly. So dilution is the term, the encompassing broad term for just decreased spending power. Again, talking a lot in context of a lot of the conversation currently on CNBC. Today is June 16th, 2021. But the Fed's going to come out, I think, in an hour or something and talk about what they plan to do with interest rates and printing money. But first, like, what goes on with the Fed? Just kind of review. Remember, the Fed has infinite money. Assume that the Fed is trying to stabilize the economy without malicious intent, but doesn't know what to do, and neither do I. Simply meaning there's a lot of market players. Again, what assets do you buy? Also, if you're not aware, the Federal Reserve buys assets, holds them to stabilize the economy, and they have infinite money, then they also set the interest rates. So how does that, again, right now today, how does that develop or not develop trades? Again, I really think that it's you could have, right, a very strong correlation of interest rates, the Fed's buying a lot of assets, therefore because the economy is weak, and when they say taper tantrum, they talk about decreasing of the spending of the Federal Reserve. So for example, in 2013, the 10-year Treasury note, because of the taper tantrum, went from 1.7% to 3.5% on the 10-year. Again, as a consumer, if that bothers you, go do something. But economically, what does that tell me? Again, I think the Federal Reserve, the government agent, any government agency in general is reactionary to the populace, to the consumer in terms of economics. Or they just don't want the housing market to go up 10 million thousand % real quick, or decrease 10 million thousand % real quick. So as this consolidation of immature investors, just the 15%, meaning, we've talked a lot about momentum trades. 9 out of 10 investors, the ones that, say they lose money, or, in the very beginning episodes talked about just, people not understanding, they're just chasing like the tail end of the momentum. But I'm very confident on the market mechanics just of, again, having a bunch of different variables extended in one direction to put on a trade, and then, decreasing half your size, or, getting out your cost basis at 100, 200%. And then by the time the momentum actually kicks in, you're just managing profit, and you don't really have to worry about the personal sentiment. And I said overall, that really is what drives, phone calls to financial advisors and stuff like that. But we've talked about, literally globally, if we found a planet with a bunch of resources, we would still have to go there, fly there. There would still be supply chain issues. There'll be supply chain issues, just as is for ongoing time frames, very long ongoing time frames. Sentiment will consolidate much, much faster. That's the real variable that changes because of technology. Market mechanics stay about the same. And then if you wanted to put on a trade for the inflationary environment, it just, the thing that, because I don't know how much money is out there, because I don't know what valuations are out there, right? If I go pick one blade of grass off of a field, I didn't clear the field of grass, but I don't know what percentage of what would cause this percentage move, when I don't know, again, what cash flow, how many players, how saturated, how mature, how consolidated. And again, I say I don't know. I don't think anyone knows. I don't think that's a knowable thing. I do think there's like correlations again that could last for hundreds, if not thousands, of years based on sentiment. The sentiment is what's going to change. Make sure I'm still rolling. So just some other notes or ideas. Again, that's kind of a quick point, but I just don't think the development, again, not in any personal way, but I don't think the development of the investing environment, plenty of liquidity, sure. Talked about that last episode. But wealth protection allocations, I have wealth protection allocations, protection in quotation, are bad, and why? Meaning, right, I'm over here with a small portfolio, trying to make as 100, 300, 400%. Let's say you have, you're financially stable, you got a good retirement or a good job, the dollar figures don't really matter. But then you go into the mindset of, I don't want to lose this investment. I don't want to lose my wealth. I really think that's pretty categorically bad, just because like the market's not going to stop changing. So the sentiment of I'm going to protect myself, great. What do? Then you still have to be an investor. So I just think that any sort of general, again, that 15%, the concept of protecting your wealth will go away, as opposed to building more skill sets or making more money or stuff like that. I really think overall macroeconomic way that will have a big impact on individual movements of stocks, different financial markets, currency, commodities, anything. Risk diversification and allocation, again, meaning you have plenty of cash and it's more about how much percentage of a portfolio goes to this, to that, to that. Again, I'll be doing so once I have some cash flow. Correlation of money printing to the stock market, bond markets, currency spot pairs, and interest rates. Talked about what I wanted to talk about mainly. Again, just like I do think there are strong correlations now today, certainly. I mean, the data speaks for itself about stock market prices to interest rates, but I think as the maturity of the overall investment environment goes up, that will consolidate tremendously in quickly, sub 10 years. Anything else? Quantitative easing, again, just another term for the Fed buying stuff or some all affecting the inflation and debt or dilution environment. But how about holding debt as an instrument or as an investment? I think a business model, I think holding debt, if you're sure that people are paying back, I think that's kind of a good way to be. Just because on a personal level, if you have personal debt, personal finance debt, it's the number one thought in your brain. But I've never taken on debt. I'm not. I don't know if you just don't have human rights, so that's like my personal economic path is just different. But holding debt as an investment, like holding treasury bonds, again, I'll talk more about them. I just don't have good trade perspectives. I think there would be some sort of trade, if you're going for a couple percentages with a good amount of money. I think there'd be pretty stable trades, right? Stock market tracing a momentum trade of 100 multiple. If there's just some good structured rotations for this currency versus that commodity because of these two countries' relations for the next 25 years, I would take that trade day in and day out. Still don't have anything. That is what I wanted to say for dilution. Again, literally go on CNBC whenever they say the term inflation, just scream dilution, and it'll still make more sense. But my overall thesis is because of immature investors and because the economy is truly open and because of unknown global wealth and because of unknown value, consistent valuation, consistent accounting, how do you say what percentage of cash inflow, a billion, a million, a trillion, 100 trillion, a quadrillion, what moves what? I don't think there's enough data to really know. So that's my opinions for that, and just going off a lot of conversation on CNBC today. But thank you for watching Financial Trading Basics Part 24, Inflation and Dilution.